Hi guys, right. So this is the chapter on the consolidated statement of profit or loss, and let's profit and loss. Let's work through it. It's chapter 19 of our texts in this current season. Who knows? Sometimes it swaps back to 18 or 20, depending on what they're adding or including. So let's look at our objectives, and as usual, what I'll try and do is record these in short bits, so you can look at it and sort of go away and come back and work around it. Right, so what are our objectives? We aim to prepare a consolidated statement of profit or loss for a simple group and a non-controlling interest. So pretty much you have a group that has a parent and a subsidiary. We have already worked through the statement of financial position for these two parties. And of course, they could be three parties. I mean, why not? You can have two subsidiaries. Or even more, of course. So, and then we will look at certain things as to what goes on within to trade. I mean, it's good saying these things out of context. If you, of course, as individual companies, you will recognize any trade. So S in its own individual financial statements will recognize all trade to P. But then as a group, we are interested in trade to external third parties. After all, we're preparing accounts as a whole. So when we talk about revenue, it should be revenue or sales to all third parties. So we cannot include any of those intergroup trading. So all of that has to be eliminated. It all has to be journaled out, if you like. And preparing consolidated statement profits for a simple group with an acquisition in the period. So yeah, I mean, just you're acquiring a subsidiary and dealing with a non-controlling interest. We will also have this question of goodwill. So of course, a group company now has the additional asset of goodwill because the parent has paid more, if you like, for the subsidiary than its standing net asset value, so to speak, because you want it, so you pay a premium for it, and so you have this asset of goodwill. Of course, there is also goodwill accorded to if the fair value measurement is being used for the non-controlling interest, they will also have a share of that goodwill. So according to I mean, it's an intangible asset, IAS 38. We have to impair, if you like, we need to annually review goodwill. And given that we assume that we can find good valuations or good valuers who can enable us with the impairment process, we can impair this intangible asset over a period of time. And of course, that goodwill. So when we do consolidated statement of financial position, we talk about that anyway, right? We talk about goodwill, but the actual process happens through here. Well, I mean, when I say we talk about it, we do credit in the statement of financial position. We say credit goodwill, don't we? And we debit working 4 and working 5. That's on the statement of financial position to retained earnings. But of course, when we're actually looking at the income statement, which is really the process of loading retained earnings, we have to recognize that within the statement. Of course we do, and that's where we see that. And of course, prepare a consolidated statement, profit or loss, and other comprehensive income. We will talk a bit about OCI. I believe at this level, OCI for us typically is to do with, if you like, revaluations, right? So when you have revaluations of non-current assets, the standard IAS 16 does not allow you to, if you like, recognize that those gains within your profit or loss. No, it says that you have to recognize that, if you like, within the other comprehensive income, and that shifts off to your evaluation reserve. And also, we will be looking at some financial instruments in Chapter 9. So financial instruments, typically, again, there's a policy, there's a choice. Well, when I say there's a choice, it must be relevant and you must follow the standards. So certain financial instruments are held at fair value through other comprehensive income. So, of course, that other comprehensive income, if you like, will show up there as well in the other comprehensive income section. The consolidated statement shows the profit generated by all resources disclosed in the related consolidated statements, and pretty much we're just talking about what's all the income and what's all the expense for both parties. So in effect, everything to do with the parent and the subsidiary Okay, right. What else? So So it follows the same basic principles, kind of similar to the statement of financial position. Um, what we are trying to do, so from revenue to profit, we include all of P's income and all of S's income. So P is the parent, S is the subsidiary, simply because we recognize that P controls the organization. So we must recognize everything as a whole. And of course, once we now finish, we then show the split, if you like, between what is attributable to the parent and what is left, or so to speak, or let's put it this way, we first of all analyze what belongs to the subsidiary, and the balance must be what belongs to the parent. So just saying it out of context, if A and B if you invest all their profit for A and B, so revenue, expenses, operating costs, revenue, expenses, operating costs. When we add them together, yes, we add them together, but we must recognize and not forget that our total, when we add them together here, the share of this total is really, say for example, the subsidiary, the non-controlling interest owned 20% of B. Ultimately, we want to calculate 20% of B's profits and deduct that from the total, right? Because everything else must belong to the parent. Remember, the parent can have a range of other income pieces coming in from other subsidiaries. Right, the mechanics. Again, we typically create a group structure program, so we understand who owns who's in control of who. And then we literally just add these things together. It can be that quite straight. You're just adding across everything that's going on. Of course, we will see some adjustments. And we will then later on, of course, in the course of this lecture, look at the certain adjustments that need to be made. And I'll talk about those when we can. But ordinarily, what we're really trying to do is to add these income pieces together. So we will also deal with any workings for unrealized profit. We discuss this anyway within statement of financial position. So the PERP, the unrealized profit, is nothing new in effect. What we're really doing here is that we are debiting retained earnings, right, and crediting closing inventory. Now, this is how we deal with it, isn't it, in the statement of financial position? But in the income statement, that's the closing inventory business that we're talking about. That's really what's happening. That closing inventory, as you remember, shows up. Closing inventory shows up as an asset as well as, if you like, in cost of sales, so to speak. So we're adjusting it in cost of sales. We mustn't forget that. And that's what we're ultimately going to be looking at when we do it. Right, and also looking at, again, the non-controlling interest. So the non-controlling interest bit will look like this. The non-controlling interest, I actually argue that the non-controlling, we almost wish I could turn this on its head, where you had something, working 2 of your statement of financial position says net assets at ACCA, net assets at reporting, post-ACCA. So if you have net assets, the profits at ACCA, profits at reporting, and you have post-ACCA. This post-ACCA, remember, we share it, split it between parent and subsidiary. In effect, this whole working 2 is to do with the subsidiary. This is the entity, the equity section of the accounts. And this retained earning movement, this is just retained earnings, is it not, right, from one period to the next, which is in effect the income statement, right, because that's really what happened. And so we then take a percentage, which is what we're really doing. We have that figure there. That's a subsidiary profit after tax. That's that working 2. And we want to split it. But now there's a number of things that we will consider, as you can imagine. First of all, any goodwill impairment, of course, I highlighted. We credit goodwill and we debit. If the non-controlling interest has been measured at fair value, we debit the parent earnings, which is working 5, and we debit working 4 with its own share. Working 4 is to do with the non-controlling interest. That's why you see this here as well. Of course, if the subsidiary had sold goods to the parent, it would be the profits would be sitting in the retained earnings of the subsidiary if they had sold the goods, right? Because they are the ones who would sell the goods, they would have the additional revenue, they would take off the costs, and so that profit would be sitting there. And we have to eliminate that, don't we? So that's where we would have a scenario where you have something like this. Sorry, this was the goodwill, sorry. And this here was, of course, if you have the standard IFRS 13 requires that if you like. But just in general, I think it's prudent to recognize all assets when you buy them at fair value. So if you're going to buy a subsidiary, it's only fair the subsidiary gets a chance to get the best value for what they have. They probably haven't revalued their assets ever until you came along. So we have to recalculate it to fair value. And those assets that have been revalued will fall, if you like, over the period of time. So that additional depreciation is what we deal with here when we say fair value depreciation. I mean, really, that's what's coming up off equity, isn't it? Because we are crediting the asset up here and therefore debiting retained earnings with that depreciation, additional depreciation. Okay, great stuff. Let me see. Yes, let's see. So I think it's a good thing. What we'll do is, I think what I'll do is let me go all the way to the. We'll stop it just before we do the question. So again, like I said earlier on, the intergroup trading, what we have to do is that that intergroup trading is included in the sales revenue of whoever sold it, and that needs to come out. So literally what you have is P's revenue plus S's revenue minus that intergroup sale, the actual journal. So if you had sold goods to your subsidiary for £10,000, you would be recognizing revenue of £10,000. Your subsidiary will be recognizing purchases of £10,000. So we literally need to remove both out of the process. Any loans, of course, in the same way, if you had lent any money or any current accounts, we sort of do that anyway, don't we, on the statement of financial position. This, I believe, must be to do with the interest. Of course it is. So if there's a loan outstanding between the groups, typically, right, you can accrue interest, of course, by anyone. You would accrue interest because you've lent money, but that interest cannot show on the accounts because we're talking about only items external or related to the third party of both group and subsidiary. So we must eliminate the effect of that as well. So we need to deduct that. The other thing, the final thing, I think, just before we is, for example, if there's this is just a timing issue, right? If you take out a loan mid-year, so if there's a mid-year acquisition, whatever, be careful with the finance costs, as the finance costs may include interest on a loan from the parent, which has also arisen in the post-acquisition period. So it's just really being aware of the cutoff and recognizing that it's only the interest. So, for example, if the subsidiary's finance costs were $400,000, the parent had owned the subsidiary only for 6 months, then the finance cost to be consolidated would be half of that, right? And that's kind of the, if you like. However, if on acquisition the parent loaned the subsidiary $2 million at 10%, there will be, if you like, $100,000 in the second 6 months that would not appear in the first six months. So, key point really is that what we want to do is that we only want to once we own this business, once we take control, we cannot recognize any interest. If we had a small holding in like a 10% or whatever, that's fine. You recognize the interest. But anything, or if we just lent them the money prior, if we had lent them money and then we now acquire them halfway into the year, we only recognize that interest anyway as part of the individual accounts, of course, but we eliminate it, if you like, on consolidation. That's the important thing. Okay, great stuff. And we'll see examples of this, so I wouldn't worry. Same thing with the dividend. Subsidiary might pay dividend to the parent. Doesn't really matter who pays who. Key point is that those have to come out. You cannot recognize any internal transactions between group and parent, and parent and subsidiary. Yes, and well, dividends to the group, if you like, to the parent, cannot recognize. I think it's just understanding it. I don't think they're going to really test you on it in terms of calculating dividends and everything. It's just knowing that you know that you need to get rid of it and looking at it carefully. I mean, sometimes you might have to work it out. Remember that a parent might have dividends from a number of companies that are external, and within that set of dividends, you would now see dividends from subsidiary. So that's the only thing you're deducting, right? All the other dividend is free to hold if you like, a subsidiary itself might be receiving dividends from other third parties, and that's all fine. It's just internal dividends. All right, that's bang on 15 minutes. I think we'll stop there, and then I'll carry on with the example in the next lecture.